Apollo has agreed to pay £7.15 per share for easyJet.
Right.
That is precisely an 81% premium. 81% above the airline's £3.94 closing price on May 28th, which was right before takeover interest became public.
And that agreed offer values easyJet's fully diluted ordinary share capital at approximately £5.7 billion.
Or roughly $7.7 billion at the exchange rate reported when the deal was announced. For you, as an institutional investor evaluating this sector, we have compiled the relevant market analysis, balance sheet data, and regulatory filings to establish the primary focus of our analysis today.
Because the core question requires immediate attention.
It does. The aircraft did not suddenly become 81% more productive. Its airport access did not suddenly become 81% scarcer. And passengers, well, they did not suddenly start paying 81% more for their tickets.
What changed was simply the price private capital was willing to pay for the exact same underlying business.
Precisely. And aviation has historically been incredibly unforgiving to capital.
Unforgiving is the right word. If you look at the margin data first, it tells a very consistent story. Airlines can execute their business plans perfectly flawlessly, even and still be completely derailed by external shocks.
Oil prices fluctuate.
Airspace disruption occurs. Aircraft deliveries are delayed by manufacturers. A sudden change in consumer demand can materialize overnight.
And transitioning to private ownership does not remove any of those macroeconomic vulnerabilities. A private owner remains entirely exposed to those exact same structural realities.
So the underlying tension of this entire analysis is whether easyJet can actually generate better returns under private ownership without sacrificing the financial resilience that is absolutely necessary in this sector.
To understand how Apollo plans to extract that return, we really need to audit the physical machinery they just bought. Look at the data projected for the end of March 2026. easyJet operates roughly 356 Airbus jets.
But the critical metric isn't just that total volume. It is the composition of the fleet.
Let's break that down. You have 79 A319s, 180 A320s, 75 A320neos, and 22 of the larger A321neos.
And the current management strategy dictates systematically purging all 79 of those older, smaller A319s by fiscal 2029.
Replacing them with a mix of larger A320s and those massive A321neos.
Which alters the underlying unit economics of the entire business.
It does, because a flight carries significant costs that remain static, regardless of how many passengers are sitting in the cabin.
Right, you pay for the flight crew, you pay the airport charges for landing, you pay for ground handling.
You pay the aircraft lease or the ownership expense.
And if you can take those rigid fixed costs and divide them across a much larger number of seats, while simultaneously improving the fuel burn per seat with newer engine technology on the Neo variants, the fundamental mathematics of the route improve.
I have to push back on that, though. You are outlining the theory of upgauging, but buying bigger planes in a weak economy does not automatically create efficiency.
It creates more inventory.
Exactly. It creates a lot of expensive empty middle seats. Low-cost aviation is fundamentally a utilization game. Spreading fixed costs over more seats only works if passenger demand is actually robust enough to fill that new capacity.
Because an empty seat generates zero revenue.
Zero. Yet the heavier capital cost of that larger airframe continues to sit right there on the balance sheet. Management has targeted a medium-term ambition of more than £1 billion of profit before tax. That heavily relies on filling these larger aircraft.
So how does Apollo square that risk? That is the primary friction point here. These intended efficiencies from larger aircraft, they only materialize after massive amounts of capital are firmly committed.
Aircraft are not procured on short notice.
They are ordered years in advance. Cash deposits are paid up front. Deliveries are financed through highly complex capital structures long before the aircraft generates a single pound of revenue.
Which introduces the central contradiction of private equity entering commercial aviation. Private equity fundamentally demands cash-generative businesses.
But airlines periodically demand massive amounts of cash, simply to renew the machinery required to stay competitive.
The new aircraft might be highly efficient eventually, but the corporate balance sheet has to actually survive that multi-year transition period.
Well, if we look at the balance sheet right now, easyJet enters this transaction from a highly defensible liquidity position.
They do. At its latest half-year results, the company reported approximately £4.7 billion of liquidity.
$4.7 billion.
Their net cash stood at £434 million. Furthermore, the book value of their own assets was approximately £5 billion.
So this is clearly not a distressed rescue operation. Apollo is acquiring substantial physical assets and deep liquidity.
But that shifts the strategic problem. How should those £5 billion of owned assets be financed moving forward?
An airline management team has several levers. They can purchase an aircraft with cash. They can borrow against it. But the mechanism that warrants the most careful scrutiny under private equity ownership is the sale and leaseback structure.
And Apollo brings extensive institutional experience in aviation finance. They could theoretically use this structure to extract immediate capital.
I think we need to examine how the market often views that mechanism. Because sale and leasebacks are frequently mistaken for true value creation.
Think of a sale and leaseback like selling your fully paid off family home to a bank to instantly clear a massive credit card bill.
But then agreeing to rent that exact same house back from the bank.
Yes, your balance sheet looks incredibly flush with cash today, but you have just locked yourself into paying rent for the next 15 years, even if you lose your job.
The airline converts a tangible owned asset into immediate liquidity, but it is coupled with a rigid future fixed obligation.
That is the precise danger. Under certain low cost of capital scenarios, it is a sensible allocation. Under others, it drastically reduces corporate flexibility.
The financing structure must serve the operational needs of the airline, not the other way around. Aviation brutally punishes fixed obligations the moment macroeconomic conditions weaken.
Debt interest still requires payment.
Lease rentals still require payment.
The aircraft mandate rigorous maintenance regardless of passenger volumes.
We have the exact data proving why those fixed obligations are dangerous. Look at the first half of fiscal 2026.
easyJet's headline loss before tax widened to £552 million.
$552 million.
Management explicitly attributed this to higher fuel costs and weaker forward booking visibility, which was tied directly to conflict in the Middle East.
A structurally weak winter season can arrive immediately after a highly profitable summer. It erodes cash reserves far faster than a complex lease structure can be renegotiated.
If Apollo attempts to earn its premium simply by layering more fixed lease obligations onto easyJet's balance sheet, that financial engineering will fail in the next downturn.
So if financial engineering alone is a trap during a cyclical downturn, how does Apollo actually justify the 81% premium?
They cannot just squeeze the balance sheet harder.
No, they must rely on actual structural operating improvements, which directs our analysis to easyJet's most asset-light growth engine.
That brings us to the easyJet Holidays division. The margin data here alters the corporate profile significantly.
In fiscal 2025, this division generated £250 million of profit before tax.
And their target is to reach £450 million by fiscal 2030.
Economically, this is vital because it shifts how the airline monetizes the individual traveler. Look at a standard flight. An airline seat is the ultimate perishable inventory.
The moment the aircraft pushes back from the gate, an empty seat loses all economic value. It cannot be stored.
But a holiday package changes the entire supply chain. It allows the airline to extract higher economic value from a customer who is already captured in its network.
Instead of just earning the margin on a single base fare, the airline captures revenue from the hotel accommodation,
The ground transfers.
and other ancillary products. Economically, that single traveler becomes substantially more valuable to the enterprise.
And crucially, easyJet captures this expanded margin without having to commit the massive capital expenditure required to buy and operate an additional flight.
Furthermore, they do not have to acquire, build, or own the physical hotels.
I do think we need to challenge the romance of that upside, though. It sounds like a perfect high-margin machine. But premium hotel supply in Mediterranean destinations is not infinite.
As capacity tightens, customer acquisition costs naturally rise.
And easyJet is fighting entrenched, aggressive competitors like TUI and Jet2 who specialize entirely in package travel. The holidays business is not a guaranteed yield.
The point is not that the holidays division somehow insulates aviation from risk. The critical point for you, the investor, is that it alters the fundamental mix of corporate earnings, diversifying them away from pure, highly volatile airfares.
To feed that lucrative holiday funnel, the aircraft must fly from locations with high-value catchments. You cannot sell premium holiday packages to a high volume of travelers if your network is based in remote locations.
This shifts our focus from manufactured assets like the Airbus fleet to non-manufactured assets, specifically the moat created by scarce airport access.
Right. easyJet has systematically built dominant positions at primary slot-constrained European hubs.
We are looking at prime capacity at London Gatwick, Geneva, and Milan Malpensa. A well-capitalized competitor can easily call Airbus tomorrow and order a fleet of new jets.
But they cannot call local authorities and order another London Gatwick to be built.
The inability to replicate that infrastructure creates durable scarcity. You face hard limits on physical runway capacity,
You face stringent local planning restrictions.
tightening environmental rules.
And above all, historical slot allocations that heavily favor incumbent operators. This creates a physical and regulatory barrier to entry.
You might be wondering why easyJet doesn't just copy Ryanair's model, heavily utilizing secondary airports far outside major city centers to engineer a much lower cost base.
easyJet deliberately accepts higher operational costs to maintain access to primary airports.
I view this entirely through the concept of return on capacity. Paying a premium fee at Malpensa is not automatically a value-destroying cost if it unlocks the highly dense demographic needed to hit that £450 million holiday target.
Exactly. If that primary airport grants access to a customer base that reliably produces stronger base fares and consistent holiday bookings, then aggressively cutting that airport cost to mirror a secondary airport model would actually destroy enterprise value.
Moving an aircraft instantly on a spreadsheet is easy. Executing that within the actual industrial operation is different.
Managing crew domiciles, maintenance infrastructure, and highly contested slot times, that is structurally rigid. Apollo has to find its returns inside that rigid physical system.
And because these prime slots and physical operations are governed by international law, Apollo faces a barrier that neither aircraft financing nor route optimization can bypass.
We must confront the regulatory operating system.
Apollo is an American private equity group. easyJet is headquartered in Britain, but its intra-European operations rely entirely on satisfying strict European airline ownership and control requirements.
This creates a severe structural complication. To satisfy non-negotiable EU rules, an American firm cannot simply buy the entire equity base and vote the shares as it pleases.
The proposed transaction limits Apollo to holding less than half of the ordinary capital.
They must utilize an EU management trust and rely on continuing European shareholders. This is necessary to preserve the qualifying European ownership percentage required for easyJet to legally fly between EU member states.
But aviation authorities look at far more than just equity percentages on a capitalization table. They rigorously examine effective control.
Corporate governance, the distribution of voting rights, and the mechanics of strategic decision-making are all heavily scrutinized.
Because of EU laws, Apollo literally cannot exercise dominant control over the European operating entity if they want the airline to keep flying.
They are not just buying a fleet of hardware. They are buying into a sovereign regulatory web. The operating certificates, the traffic rights, and the safety obligations are part of the asset itself.
That regulatory reality strictly constrains what the new owner can execute. Apollo cannot tear the system down and rebuild it entirely according to their preferred financial architecture.
They are forced to find their returns inside the existing constraints.
Paradoxically, the exact same regulatory and infrastructural barriers that constrain Apollo also protect easyJet's enterprise value, making it incredibly difficult for new competitors to reproduce their network.
Synthesizing this data, there are two credible paths for this investment moving forward. Let us look at the strong version first.
In the strong version, Apollo acts as a patient, long-term industrial owner. The modernization of the fleet continues, shifting toward the larger A321neos, improving unit economics where passenger demand actually supports the capacity.
The easyJet Holidays business scales toward its £450 million target, extracting more revenue from each individual customer.
Aircraft financing mechanisms are used strategically, and easyJet deliberately retains enough core liquidity to absorb the next period of operating stress.
In that scenario, the 81% premium begins to make rational economic sense because the underlying industrial business is materially better.
But the weak version of this thesis presents a severe risk. In this scenario, aviation fuel remains persistently expensive.
The mandatory fleet investment continuously drains cash flow.
The anticipated growth in the holidays division stalls against entrenched competition.
To compensate, Apollo loads the balance sheet with fixed lease obligations and debt. And then, the next cyclical downturn hits.
An over-obligated easyJet, stripped of its liquidity buffer, is suddenly defenseless.
For the public shareholders taking the cash offer today, the immediate economic reality is clear.
They are cashing out at an 81% premium above the May 28th unaffected price. The risk of future capital deployment is entirely transferred to private hands.
But this leaves a broader question for the sector. If private equity successfully transforms legacy European carriers by extracting higher margins from existing assets, we may be looking at the beginning of a much wider wave of institutional capital moving against public market airline valuations.
Tell us, which part of easyJet creates the greatest long-term value? Aircraft economics, scarce airport access, or the holidays business? Subscribe to the Unlayered Global for more analysis of the money and operating systems beneath global business. The takeover will not prove that easyJet was mispriced simply because Apollo offered an 81% premium. It will prove something more demanding only if the operating results eventually support it. That easyJet was worth more because its assets could be operated better, not merely financed differently.